Thinking about investing but feel lost? You're not alone. The stock market can seem overwhelming, but you don't need to be a Wall Street expert to get started. Today, I'll break down the basics. No jargon, no hype, just a simple, step-by-step guide to help you start building wealth. We'll cover how to find your investing style, open your first account, and pick your first investments. By the end, you'll have a clear, actionable roadmap. Investing isn't just for the rich, it's for anyone ready to secure their future. Let's take your first step toward financial freedom right now. Before you invest, take a moment to reflect on your goals and your personality. Ask yourself, what kind of investor do you want to be? Are you someone who enjoys diving into details, or do you prefer a more hands-off approach? There are two main paths you can take: active investing and passive investing. Each has its own unique style and demands. Active investors spend time researching individual companies, following market news, and analyzing trends. They aim to beat the market by making smart, timely decisions. This approach can be exciting and rewarding, but it's also time-consuming, stressful, and comes with higher risks. You need to be ready for ups and downs. Passive investors, on the other hand, buy index funds or ETFs that track the whole market. They don't try to pick winners, they invest in everything. This method is simple, low stress, and doesn't require constant attention. Historically, it's outperformed most active investors over the long run. For most beginners, passive investing is the best way to start. It lets you grow your money steadily even if you're busy with work or studies. You don't need to spend hours researching or stressing over every market move. Just a few minutes a month can be enough. Set up an automatic investment plan and let your money work for you in the background. Over time, small regular investments can add up to big results. If you're curious or want to learn more, you can always experiment with active investing using a small portion of your portfolio later on. The key is to be honest with yourself about your available time, your interest in investing, and your comfort with risk. There's no one-size-fits-all answer. Decide which path fits your lifestyle, your goals, and your personality best. Remember, this choice will shape your entire investing journey, so take your time and choose wisely. Start with passive investing to build a strong foundation, and as you gain confidence, feel free to explore more. Ready? Let's move on. You don't need thousands to start investing, just the habit of starting. Even if you feel like you have only a little to spare, what matters most is building the discipline to invest regularly, no matter the amount. Thanks to fractional shares, you can begin with as little as $5 or $10. Modern investing apps make it easy to buy small pieces of stocks or funds, so you don't have to wait until you have a big lump sum. The real question is, how much can you consistently invest after covering your bills, essentials, and building an emergency fund? Take a close look at your monthly income and expenses to find a realistic number you can stick to. Never invest your emergency money. Keep 3-6 months of expenses in savings. This safety net protects you from unexpected setbacks like job loss or medical bills, so you won't have to sell investments at a bad time. Once that's set, look at your budget for extra cash you can invest monthly. Even small amounts add up over time, especially when you make investing a habit. Consistency beats a big one-time investment. Regular, automatic contributions help you build wealth steadily and take the emotion out of investing. Next, know your risk tolerance. How would you react if your investments dropped 20%? Understanding your comfort with ups and downs helps you choose the right investments and stick with your plan during tough times. Younger investors can take more risk, since they have time to recover from market drops. Those closer to retirement should be more conservative, focusing on protecting what they've built. Track your spending, cut unnecessary expenses, and automate your investments. The less you have to think about it, the more likely you'll stick to your plan. This is called dollar-cost averaging, a proven way to build wealth over time. By investing the same amount regularly, you buy more shares when prices are low and fewer when they're high. Start small, be honest about your risk, and focus on consistency. Over time, your confidence and your investment amount can grow together. Investing $100 a month beats investing $1,000 once and stopping. The power of compounding works best when you keep adding, month after month. Get your financial house in order, and you're ready for the next step. Let's open your account and put your plan into action. Time to open your brokerage account, the gateway to investing. Choose a platform with low fees, an easy-to-use interface, and solid customer support. Look for zero commission trades. Don't pay unnecessary fees. Popular beginner-friendly options include Fidelity, Schwab, Vanguard, Robinhood, and M1 Finance. Opening an account is simple. Download the app, enter your info, and link your bank. Most accounts are approved in a day or two. Once funded, you're ready to invest. Don't stress. This step is easier than opening a bank account. Do a little research, pick a platform that feels right, and get started. You're officially an investor. Your account is open and funded. Now it's time to invest. This is a big milestone, and you should feel proud of taking the first step toward building your financial future. But before you dive in, let's talk about how to make smart choices with your money. If you're a passive investor, the easiest way to get started is by buying a broad market index fund (ETF) like VOO, IVV, or SPY. These funds are designed to track the overall market, so you don't have to pick individual winners and losers. With just one purchase, you get instant diversification across 500 of the top companies in the US. This means your risk is spread out, and you're less likely to be hurt by one company's bad day. All you need to do is search for the ETF's ticker symbol, enter the amount you want to invest, and hit buy. It's really that simple, even if you're brand new to investing. If you're more of an active investor, start by looking at companies you know, love, and use in your daily life. Think about the brands you trust and the products you can't live without. But don't just buy a stock because it's popular. Take time to research their growth, profits, and overall value. Look at their financial health and future prospects, not just the latest headlines or hype. Use free tools like Yahoo Finance, Google Finance, or your Brokerage app to check out basic information, recent news, and analyst opinions. These resources make it easy to compare companies and spot trends. Build a story for why you believe in a company's future. Ask yourself, does this business have room to grow? Is it solving real problems? Do you see yourself using their products for years to come? Remember, don't put all your money in one stock. Diversification is key to managing risk and smoothing out the ups and downs of the market. A good rule of thumb is to keep about 80% of your portfolio in index funds and use the remaining 20% to experiment with individual stocks you believe in. Make sure your picks match your personal goals and risk tolerance. Everyone's situation is different, so invest in a way that feels right for you. Whether you're a passive or active investor, always do your homework. The more you learn, the better your decisions will be. And never invest more than you're willing to lose. The stock market can be unpredictable, so protect yourself by starting small and staying cautious. Start with small amounts, keep your portfolio diversified, and always keep learning as you go. Over time, your knowledge and confidence will grow. You've just made your first investment. Congratulations. This is only the beginning of your investing journey. Investing isn't a one-time event, it's a lifelong habit. The real secret? Consistency, patience, and compound interest. Set up automatic investments every month, no matter what the market's doing. This is dollar-cost averaging. It smooths out your purchase price and removes emotion. Turn on DRIP, Dividend Reinvestment Plan, to automatically reinvest dividends. Compound interest is your money, then earning even more. Over years, this snowballs into real wealth. There will be market drops. Don't panic and sell. The winners are those who stay calm and keep investing. Time in the market beats timing the market. Keep learning, but don't obsess over daily price swings. Check your portfolio monthly, focus on the long term, and trust your plan. Be patient and disciplined. Let compounding work for you. Building wealth is a marathon, not a sprint. You've started, now, keep going. That's your beginner's guide to investing. You now have a clear, simple plan, no more excuses. The best time to start was yesterday, the next best is today. Start small, be consistent, and let compounding do the work. This is about building a secure future, one step at a time. Join our community for more tips, like subscribe and take control of your financial destiny. Your journey starts now.